So we are doing journal entries for a periodic company, a company that does their inventory on a periodic system. The following merchandising transactions for Scout Systems assuming a periodic system. So Scout Systems purchases merchandise for $4,400 on credit with terms of 210 net 30. So what this means, just so you know, N30 or net 30 means the balance must be paid. The balance must be paid within 30 days. 210 is incentive for you to pay early. So the company is willing to give a 2% discount if paid in 30 days. Pardon me, yeah, 10 days. In 10 days. So Scout System purchases merchandise for $4,400 on November 1st. So we have purchases, and we have our accounts payable. We can go, I'll just put the terms, 210 and 30. And it's for $4,400. Now, Scout Systems pays for the previous purchase. What, if you have a look at the dates though, you'll see it's 4 days later. So there is a 2% discount, exactly. So on November 5th, we know that our accounts payable would be debited. But we are also paying cash. But are we paying $4,400 of cash?
No.
No. How much are we paying? $43.12?
Yeah.
Can we debit accounts payable $43.12? What's the what would be the issue if we debited $43.12? Yeah, we're going to use a discount, but the reason why we don't just close this with a $43.12 debit is because our accounts payable is our ledger of money we owe. After we pay this bill, $43.12, do we owe that company any more money?
No.
No, but it would show that we owe them $88 if we didn't bring the balance to zero. So we know we have to bring the balance to zero because we don't owe that company. We have no obligation to them. Now, what's the problem with this? Why can't we close it right here? Yeah, we're going to use the discount because it doesn't balance. So now we use our purchase discounts. On November 7th, Scout Systems receives a payment for returned defective merchandise of $500 that was purchased on November 1st. So, in this November 1st purchase, $500 was defective. So what are we going to do? We're going to return it. So what we have here is we're not going to use our purchase discounts. The other thing is we've paid this bill. So there's kind of two ways that you'd be okay doing it. Typically what you would do in your accounting software or in your accounting system, you would actually have a negative balance or a debit balance in your accounts payable against that supplier. So next time that they sent you a bill, when you go to pay it, you would just have a discount already in your system. But if you were to do like accounts receivable because they owed you money, that would also be fair. But the proper way would actually just to have a debit balance. So even though we don't typically have the normal balance of a payable is not debit, there are scenarios like this where you could have a debit balance. So we have our accounts payable.
We can use an advance to suppliers.
No, because advance to suppliers would be you paying them ahead of them supplying you anything. But this, you're sending inventory back to them,
Yeah.
so they owe you. They owe you a credit.
Like a purchase return.
Purchase return.
It's not. It is a purchase return, yes.
So we made it
But-
two entries or one entry.
It's going to be one entry. So we're gonna debit our accounts payable the $500. This puts a credit on their account because this would actually have a name attached to it, right?
Yeah.
Our accounts receivables and our accounts payables will actually have specific customers and suppliers attached to them. We haven't done that in the first 2 months. What we've done is just wrote AR or AP, but in real life, this would be like AP, I don't know, M&M Company X. Then you have AP Company Y, Company or AP Company Z, and that's typically how it's managed. And the same for accounts receivables. So in this case, we've just created a credit note or a credit, and then we would credit our purchases, returns, and allowances. And can anyone tell me why we have not touched our merchandise inventory account yet? Because in a periodic company, we only do an adjusting entry at the end of the period before creating our financial statements to adjust our inventory totals. That's the difference between perpetual and periodic. Perpetual does it every transaction. Periodic will do it only at the end of the period when they do a count, typically. So November 10th, Scout Systems pays $400 to transport merchandise to its store. So we have November 10th, transportation, in, meaning this is merchandise coming in, and doesn't say credit, so we can go cash. There's $400.
Sir, on November 7, Score System receives payment for return merchandising 500 was purchased on one number. They also received payment.
Oh yes, sorry,
So
you're
they
right.
have received cash. So it should not be this entry.
Good catch. Yeah, good catch. Typically in real life, that you wouldn't get the cash, you would just send it back, and you would get a check later, or you would just have the credit. But yeah, that says receives payment, so good call, good catch.
You adjusted with the next purchase.
Typically,
Yeah,
yeah,
yeah.
99% of the time it is, yeah. Or you could request a check back, but you wouldn't get it until weeks later. Yours, yeah. Okay. This transportation. So the reason we don't use transportation expense, typically our merchandise inventory, in general our merchandise inventory, all the costs that are prepared to get it ready for sale are applied to the value of the merchandise. So if you have to spend like on an additional expense for shipping, so you purchase inventory, you buy it from the supplier for 10 grand, and then a week later you get a bill from the shipping company for 1,000, you have merchandise valued at 11,000, not at 10,000. Even though the replacement from that company is 10,000, it's the total cost to basically prepare your merchandise for sale. If you have to buy insurance on it as it's being shipped or in your store, that is the cost of your merchandise. So your overhead or your operating expenses are all of your expenses that do not reflect the cost of preparing your merchandise for sale. And we're going to talk about that a little bit when we get to the income statement. So if you had to receive merchandise and then paint it blue, the cost of the paint and the labor to paint it blue in your store would be the value, would increase the value of the merchandise. Okay? Whatever it costs to prepare your merchandise for sale, including transportation, insurance, doing anything in the store, it would be added to the value of the merchandise. And any discount you get against your merchandise would reduce the value of your merchandise. So that's why we use this transportation. It's going to be a cost of goods sold account, a COGS account, because it was for your merchandise. If this transportation expense was for a couch that you put in your office, or a desk put in your office, then that would not be a transportation, that would just go to transportation or delivery shipping expense. That would be an overhead expense. Okay, sorry, where are we now? November 13th. Scout System sells merchandise for $6,500 on account. The cost of the merchandise was $4,200. So, we sold the merchandise on account, so we know we're going to use our accounts receivable. And again, this would be, in real life, it'd be like customer Y kind of thing, customer Y. But just for us, we're just using accounts receivable. It's generic. So we sold the merchandise for $6,500 on account. The cost of the merchandise was $4,200. So accounts receivable, and we have sales of 66. The accounts receivable is for 6,600 because that's what the customer owes us, and our revenue account 6,500, and the revenue account is 6,500 because that's how much money we will receive. So, to record. Now, in a periodic system, how do we want to account for the cost here of the merchandise?
In which account? In periodic?
Yeah,
We calculate it at the last.
yeah. We're not going to do it. This doesn't matter to us because we do our cost of goods sold calculation at the very end as an adjusting entry. If this was a perpetual example, which we'll do next week, then yes, we will. We would recognize it at that exact moment. And on November 16th, a customer returns merchandise from the November 13th transaction. The return item sold for $1,200 and the cost $780. The item will be returned to inventory. It's important that this item is returned to inventory because, you know, if it was scrapped or if it was, I guess actually it doesn't matter at this point. In perpetual, it matters. So, for now, we're going to do our customer returns. We have on November 17th, 16th, sorry. Why do I'm just off by one number each time. November 16th, customer returns merchandise. The returned item sold is for $1,200. So we don't reverse our sales. We're not going to debit our sales. We're actually going to debit our sales returns and allowances. We're going to credit our accounts receivable. It's for $1,200. So now they only owe $6,300, right? Because we've debited our AR for them, and then we credited them $1,200. To record customer returned.